Game on.
Welcome.
Yeah.
Here we are. We missed last week, but we're back and badder than ever this week with Resolve Riffs. This week, we've got Chris Schindler, who I'm pretty sure was our most popular guest in terms of podcast engagement over the last 6 months or so. And Chris, I think we spent about an hour and a half, maybe a little longer than that with you in our initial podcast, Rodrigo and I. And then there's like another hour afterwards of kind of post-mortem on that conversation. Yep. And then lots of grist under the mill since then. So we're really tickled to have you back on. For those who've been hiding under a rock and don't know Chris, maybe Chris, just give a brief overview of your professional journey.
Sure. So I spent 18 years or a bit over 18 years at Ontario Teachers, where I started in the asset liability modeling group, joined a nascent little team called TAA, which turned into tactical asset allocation, which turned into the capital markets group. While I was there, I sort of founded the sort of the macro systematic team, and we ran that through to 2016, which was that was sort of a risk parity, CTA, global macro, risk factor, alternative risk premium, equity quant, volley kind of stuff. Like anything. It was a very, very broad mandate. Anything liquid and systematic. And we also it was a pretty cool seat because we also invested in managers through a good chunk of that, starting in like late 2008. So that was a really, really cool seat. In 2016, Teachers created a new portfolio, a new department called Portfolio Construction Group, which sort of took over ownership of total fund oversight, really, or at least kind of shared it with the board, whereas before the board completely owned it. And so we worked closely with the new CIO. Total fund issues, which we're going to talk a little bit about today, I guess. And then in 2018, I resigned from Teachers, and I took some time off, and I spent the last little bit working on putting together my own little personal project, which is trying to start a business and a hedge fund.
Right, which is where you are today, right? Yeah. So you've spent the last few months, you built this suite of strategies. Over the last few years, you've been sort of refining that and building structures and getting seed assets and all that kind of stuff for the last little while.
Working on it.
Yep. Launching your own fund, right? So yep. That's great. So we named this podcast. What was it? Investing in the
impossible market.
Navigating an impossible market, exactly. With
those are my words.
Yeah, for sure.
It's clickbait. So, we got it. You got to do what you got to do.
But we were sort of briefing before, and I know Mike and I had like an hour-long conversation about this exact topic earlier today. We spent a lot of time, probably half the time over the last several riffs, addressing some of the reasons why this market is really hard in terms of trying to achieve required returns. And so we were briefing before this, right, about some of the ideas that you've been bringing to pension boards and others who are interested in how to think about this market and how to, let's go back to basics. How can we think about optimal portfolio construction and capital market expectations and filling some of the holes? So, I don't know. Do you want to try and take us through that narrative arc to get us going?
Sure. So I wasn't expecting to come in and monologue, but I did have this presentation.
No, don't worry. We'll interrupt you.
A year ago. There you go. So I have this presentation.
Wait. Before you do it, let's have a cheers for
cheers.
The end of portfolio management, whatever we're calling this episode.
Absolutely. I'm drinking my wine out of a pint glass.
Oh, I love the wine, the Italian wine glass you got going there. Yeah. That's fantastic.
Well, larger than the Italians are going to. I saw you guys were all wearing blue last time, so I thought I'd spice it up.
Shake it up.
Here we go. So cheers, guys. Great to do this again.
Cheers, Chris.
Cheers.
Is that salmon? Is that the color you've got on today? Is it salmon?
I was going with pink, but yeah, it's like
pink. It's a nice, salmon's just an upscale pink. Yeah, totally. Yeah. I got a Bruce.
I literally almost wore the exact same shirt and the exact same brand.
There you go.
Literally the exact same thing.
It looks way better on Chris, man.
Yeah.
Okay. So
you have to do that every time.
Yeah. So literally, as we were talking about what to talk about today, and you guys have already taken some really juicy topics like leverage and tail mitigation, and it's like I can either throw my 2 cents in on those pieces, but like I did give this presentation a year ago, so the data is all a year old, but it's okay because it's 100 years of data, so not much has changed. And I thought like there's some concepts in here which I think highlight the difficulty. Right. And I'm not saying like this is a challenge. Like this is not going to be an easy next. I don't think it's going to be an easy next 10 years for a CIO. And I say that it's not impossible. It's not the impossible markets, but it's not going to be as easy as the last 10 or 15 years have been. And I don't think anyone looks back at the last 15 years and man, that was easy. But I think when we look at this, you'll say it was easier than it's going to be. And so there's a couple things about that. And the first piece I think we got to say is like, look, from today's starting point, and we'll talk a little bit why we are where we are today's starting point. But I'm going to argue expected returns are quite low from today's starting point on almost every major asset class. And so that makes it really hard from a portfolio construction perspective when you go, do you like equities here? Do you like bonds here? Do you like infrastructure? Do you like real estate? Do you like private equity? What do you like here? And it's a small set. And then you say, what about strategies? And you say, well, like all those quivers in our, like all those arrows in our quiver over the last 10 or 15 years are also starting to look pretty attacked because man, there's so much money all chasing and doing the same things. And I'd say like, here's the problem with investing. If you do the same thing as everyone else, at best you can expect median returns, right? You can only expect to do as well as everyone else. If you do the same thing as everyone else and you get there late, you should expect below average returns. The only way to outperform the market is to get there early or to do different things. And
but not too early.
Not too early, and not too different. You can't, and not randomly different. 9 out of 10 different things are going to lose money. Like at the end, or maybe 50% are going to lose money. I don't know. But the end of the day, that's the challenge. And there's that classic: what got you here isn't going to get you there, because the last 10 or 15 years will not repeat.
Yep.
And the games that we learned and the games that worked over the last 10 or 15 years will not be as good over the next 10 to 15 years. You go, what do you do? It's not impossible. It's just harder. And so, and that's where I think, the proper foundation and starting point is paramount. And then building up on it is also super important. And it's a different challenge for $1 trillion pension plan or $500 billion than it is for a $20 billion pension plan, or it is for a $1 billion family office, and it is for someone who's just trying to invest $1 million. And obviously there's different challenges across the board. And I'm going to say there's a sweet spot in the middle there where the opportunity set doesn't look all that bad. And you certainly have a competitive advantage probably for the first time in your life as a relatively smaller investor, where you can still do a lot of this stuff where the big guys are as they are forced to fall back to the more beta investments. It's going to be a little bit more difficult for them.
Yeah. All right. Do you need to share your screen? Ani, can you allow him to share it?
All right, here we are. So, and this is, by the way, this presentation is a year old, so it doesn't include any of the craziness from this year. But I think the story still holds up. And the point is, on one hand, you think the CIO's challenge, right? I got to make 5% real over the long. Everyone's 4.5% real, 6% nominal. Like everyone's got their certain numbers, but they're roughly speaking, I got to make 5% real, and I got to do that, in perpetuity. And that doesn't sound so hard, does it? I don't know. I mean, it sounds maybe not so bad. Oh, and this is my definition of risk. And this presentation, by the way, has no equations, and it is the least technical presentation I've ever given in my life. And I'm going to say, and I'm going to define risk as I don't want to blow up along the way. And what is a blow up? Blow up's different for everyone. A blow up is I didn't meet my funding obligations. It means I couldn't pay my cash flows. It might mean for me I got fired. Like everyone's going to have a different definition of what blow up means. But as a CIO or as a CEO, however you define risk, you go, I got to make that 5% real, and I don't want to blow up. And as I said, and this was a year ago, it's like certainly true today as well. There's nothing really obviously cheap and easy right now. I don't, there's probably pockets of relative valuation, but I don't think anyone look at it and say, relative to 10 years ago, that's a steal. And I'm just going to argue that the typical, and I know you guys have spent a lot of time on risk parity on the 60-40 portfolio. The typical 60-40 equity-centric portfolio is way riskier than people think it is in the long run. It is not nearly as safe as people think it is. And that's where I think this is probably less intuitive. And I'm going to do a massive cheat here. And I'm going to say 60-40. Let's just call it equities for a second, because we forget the amount of bonds and the types of bonds, and forget that discussion for a second. Say, and a 60-40 portfolio is basically, it's like you, instead of putting all your money in equities, you just put like half your money in equities. And so just think of it as a delevered equity portfolio. In fact, I just said, like, let's just take an equity portfolio, scale it to about 10% volatility, which is about the equity piece of a 60/40, and just say that's what a 60/40 portfolio is. So I'm not going to include bonds in any part of this discussion for a second here. And let's just look, when you say most investors, and it's not just pension plans, most retail, most high net worth, most people have their wealth tied up in equities.
Yep.
And they will do well when equities do well, and they do badly when equities do badly. And so, well, but they go, that's great, because don't equities pay you 10% a year or 12% a year? What's your expectation? And they've certainly been paying a ton recently. And I think part of that is because this is US equities, starting at $1 in 1926 and growing to today. And it's like okay, so like, I guess the 2000 to 2010 looks a little ferocious, but just keep buying, keep going. It always works out. And man, look at that run recently. And I think, like, especially into 2000, did it ever look amazing? And the problem with this is the exact same data, the exact same chart. It's just in arithmetic instead of geometric. Think of this as log form, but basically the point in this is actually the equity process. A 30% pull in 1929 looks the same as a 30% pull in 1975, looks the same as a 30% pull in 2008. These are real returns, just scaled to 10% volatility. And that's what equities look like. And okay, I lied, because there's one equation in this whole presentation, and you just got to know what a Sharpe ratio is. And it's just to say, if we're running around 10% risk, roughly how much return do you make? And in this case, if the Sharpe ratio is around 0.5, it means you make about 5% real. Well, amazing. Isn't that all we have to do as a CIO or CEO is make 5% real? Why don't I just do a 10% delevered equity portfolio? Super easy, right? And the answer is, and I'm just going to full caveat here, this is statistically bunk. I completely made up the statistic. But if you look at the top, all I did was I took that arithmetic growth curve and I just filled in the high watermarks with red ink. So it's like this giant red water. And that red water is the pain of equities. Because you think there's two pain points when you own something. The first is it drops a lot, right? So you can see at each of those things from if you put all your money into 1929, well, in 1931, you've lost 35% of your money at 10% volatility. But you've also, pain is either the amount of the loss or the length of the loss. Because remember, you're trying to make 5% real. If 15 years later, you're flat, well, you're so far behind where your actual projections are that you've blown up. And so the problem with equities, you can see when you glance at this, in US equities over the last 100 years, is they make way more money than you need them to for big pockets of time, and they do way worse than you can afford for them to do for also large pockets of time. So equities alone and the equity risk factor just doesn't survive that second piece of the equation. I want to make 5% real for the long term, but I don't want to blow up, because they will blow you up. They have absolutely demonstratively blown people up over and over and over again. And we're very spoiled by the last 10 years and arguably 20 years. So.
Uh-oh. Well, Chris,
how to leave a guy hanging
online. I just want to take a moment to point out that everything on here is for entertainment purposes only and should not be used for your own investment advice. So just like Chris said, most of it's just made up. So, I mean, that's,
and it will be used against you in a court of law.
Yes.
I like the angle he's getting after that. When every one of our presentations has that fact, right? That a 60/40 portfolio is actually 90% equities, 10% bonds. But just to say, okay, given that it's 90% equities, let's just call it equities. And as we speak with pension plans, I mean, the 60/40 is just such a powerful thing. I want to believe that I use that as a trope, that I use it as something that used to happen 10 years ago and it works so well for communicating with others that I keep on using it. But time and time again, when I sit down with institutions, it is the same thing. And the only thing that may have changed is that they've gotten more private equity on their books. But that's
so they've got more equity centric,
more levered equity. So it's no longer 90
and decrease their liquidity. I think another thing that's important that I don't know if Chris was going to allude to this at some point, but he's talking about a portfolio that was funded with one cash flow at one point, right? And so what you'll have is an endowment. The reason you want 5 real is because most endowments pay about 5%, and you'd like to maintain the purchasing power of the endowed asset so that endowed asset provides 5% in perpetuity, or maybe can grow a little bit. Sometimes it's 4 or 5%. So once you introduce the income aspect whether if it is an endowment in fact, and there is distributions happening, those red areas become, incredibly catastrophic, right? So how does Yale, or how does an endowment from, a hospital or for some sort of cancer funding or whatever, how would they? So you're going to fund, you're going to have the ability to fund and grow for a 15 or 20 year period. And then you're going to have a period where you can't fund the university, you can't pay for the tuitions, there's just a decreased amount of potential opportunity to fund. And so you're just going to get fired in those situations, or someone else is going to come in and do something else. Did we reach out to Chris at all on a cell phone at all?
I'm sure
on my text right now.
Yeah, he'll figure it out. I think the point though is that what most people don't realize, because we are so myopically, and this is both cognitive and emotional salience, we're so myopically focused on recent experience, right? The recent experience has been, if you invested in equities, especially US equities, essentially you won the lottery. I mean, this has been one of the best, if not the best, notwithstanding whatever the recent couple of months, but prior to that, the best 10-year period for US equities in history. And US equities are the best performing global market over the last 120 years. So you have the best period for the best market in history over the last 10 years. This is what sets investor expectations, and it's what makes it so difficult to stress the importance of diversification, right? This whole feast or famine, literally US equity investors won the lottery over the last 10 years. This is a lottery ticket. They won the lottery. If you go back to 1966, you've got it back to 2000, there's lots of examples where 10 years, even 20 years, you get flat real returns in equities in general, but especially US equities, because there are macroeconomic regimes where foreign equities completely dominate US equities. Obviously, the knots were a really good example of that, where emerging markets and EFI were so good.
Because I'll just kind of continue on the same point that Chris was on. A couple of slides that I just recently created. Let me know when I'm sharing, Ani. The truth is that, can you see me? Are we good?
Yeah.
What you have now is, this is just we kind of all know this, right? But not only is it difficult when you have a portfolio that's 90% equities, but it's even more difficult when you have 90% equities and you're in the North American markets that are the most expensive in the world, right? And when you're just looking at the 60-40 portfolio, i.e. the 90-10 portfolio, these are the real returns from 1900 to today, or well, maybe not today, but you can, 20 years of not making money, 20 years, 14 years, and so on, right? So it is a problem to just depend on that one premium,
one bet,
to provide that return. When what I show here is this is the
hold on, now you're stealing Chris's thunder, man. He's
Chris,
you're like jumping ahead.
When did you lose me?
I was tired.
We lost you when you were about to give us the answer to all of our problems.
We lost you. No, we lost you after you were
gone again.
No.
Well,
we lost
that's the answer. All your problems are solved.
No, it's just drinks. Okay. No, I mean, literally, it was, you were just talking about.
I will end this monologue in like 2 minutes. So But
you were talking about the deep reds. That's where you were at. Pain. So the pain.
So
pain
basically,
train.
we are. Do you see my slide? I guess you don't see.
Oh yeah, Ani, can you share Chris's?
Sure.
Listen, Chris, your monologue was interrupted for 5 minutes, man. So it's no longer a monologue. Yeah. You got lots of time. Right. Don't speed through this. It's so good. I want to make sure we get to it all.
Okay.
No, you've jumped so far ahead. We literally were at the we were at the drawdown chart for equities.
Or the pain train.
That far
red pools.
Yeah.
The red pools. Yeah.
Yeah.
Okay. Let me rewind. I really was talking to myself there for a while. Okay. We're like before this.
Backity back.
Yeah. There we go.
That's the one. Yeah.
Okay. So let me quickly then pop through this piece. In the top right in the box, there's about 4 statistics. One is the Sharpe ratio. That's just like saying it makes 4.7% real per year, which is not bad. Almost what we need. But the next piece is important. The 9.6%. There is a 1 in 10 chance that if you put money in the S&P today, that 5 years from now you'll be below where you started today. And I don't think people appreciate
not accounting for valuation.
Any starting point.
Yep.
And certainly not accounting for valuations. That is just on average through time.
Yeah.
There is a 117-year period where you don't get your money back in real terms. And then this number, this 97, is just my made-up statistic. It just literally is the area of that pain. And that's just saying length is a problem, depth is a problem. Like, I guess like length and depth together, volume is a problem. So area is a problem. So you look at that and you go, that's equities. And I think it's fair to say, though it makes the returns you need almost, it will blow you up along the way. So equities alone cannot, and a 60-40 portfolio alone cannot solve your, and I don't want to blow up along the way problem as a CIO and CEO. And so I guess, like, you know, there's a lot of hopium in this world. We go like, gee, I just hope it doesn't happen to me in my lifetime. And I think that's there's that piece. Okay, so here are in bonds. You know, I created a roll bond process on US 10 years. It's you know, also scaled to 10% vol. It's not really, you know, let's not focus too much on exactly how it was built, but just to say, like equities, bonds also seem to make more money than you need for extended periods, way less than you need for extended periods. They also have their own pain points. Interestingly, if you look at the top right, actually a bit better than equities, except for it has a slightly lower Sharpe ratio, but has a better set of other definitions of risk than equities, which is interesting because Sharpe ratio is a definition, you know, like volatility is a definition of risk, but not the only definition, obviously. Anyway, so this is now the classic stock bond risk parity story, right? And you say you take your equity risk and you take your fixed income, and if you put those guys together, maybe you can average out some of that growth risk. That's the major source of risk in equities. And so if you build that balanced portfolio of stocks and bonds, and you get that stock bond risk parity, which is the risk parity that the vast majority of pension plans and investors are sort of attacking, and they're probably not going fully here, but at least they're moving towards this.
So hold on, I just want to make sure everybody understands what you're talking about here. So you're talking about equal risk to stocks and bonds, not 50-50 stocks bonds, but equal risk to stocks and bonds, which
is roughly 80% bonds, 20% equities, but then levered
exactly
up. So you can probably call it 40% bonds, and 160% bonds, and so there's leverage, and we can get into that discussion.
It's a 90-60.
It's maybe so,
ish.
So here's the thing. If some like incredibly prescient individual in 1929 went, you know what, I'm going to build a stock bond risk parity process and invested in it, I mean, well, they'd be a genius. They would have absolutely crushed it. The Great Depression becomes a bit of a nothing, but it recovers almost immediately and just goes off to the races. And if you compare it to the equity curve, it's just an absolute no-brainer. It absolutely kills it. And then probably you could totally get someone in 1965 who'd done this for 30 years, patting themselves on the shoulder and going like, who is better than me? I solved it. I broke the markets. And then this happens. You go, oh my God. And you go, there is clearly a major problem with stock bond risk parity. There's a huge hole in it. Because like, wow, that's even worse than just equities. And so if you look at just like once again, the statistics, and you go, it's actually got a higher Sharpe ratio now. So apparently this is less risky than either stocks or equities, or has more return for the same amount of risk. But the area under the curve measure says differently, and it goes, there's a massive pain point. And let's just be clear, if anyone's portfolio today of 60-40 goes through that again, none of us are in our jobs, and our pensions are not met. And we call this a failure of complete and effort proportions. Like, our actuarial assumptions cannot survive 5 years of this, let alone 20. So just to say, there's a hole in risk parity, and all the people who are just running straight risk parity are bearing that risk.
Hold on, there's a hole in stock bond risk parity.
There's a hole in stock bond risk parity.
Right.
This is pretty, I think, a pretty well-known framework. But the issue is, yes, stocks and bonds balance on growth risk, but it turns out they're both exposed to inflation risk. And so if you look at that and you say your risk parity, your stock bond risk parity process, it's got a hole in it. And you go, and like, you need another asset or another asset class that somehow can handle the inflation piece without adding too much growth risk. And you say, like, and maybe we can try and solve this a little bit. And thank goodness I'm not going to call commodities an asset class, or at least they're not necessarily a positive risk premium, but we can say there's at least something we can invest in that sits on the other side of this equation. And it allows us to somewhat build a portfolio that's now kind of ish, like diversified or immunized or protected from growth risk, and at the same time protected from inflation risk. So this stock bond commodity risk parity process, if you want to see how it looks, it's like, that looks pretty good. Now we call this a factor balanced attack because we've said we got the two major factors, and so we're kind of moving out of asset class space and talking about risk premiums and asset classes. And just for a second, just think this thing is roughly balanced between growth and inflation, and it's a significantly stronger process. Now we only have it going for 1945 because that's when we have the basic commodity data, but this is just long equal weighted package of commodities and equal risk those with stocks and bonds, and it's a significantly better process. And if you look at the statistics of it, it's got a 20% higher Sharpe ratio than either stocks or bonds, and about half that area under the curve. So it's a significantly better process.
So there's some question, right? No, you keep going.
No, ask a question, please.
No, I mean, I think there's a lot of people who sort of are scratching their head and wondering whether commodities represent a risk premium. And we in our discussion before we went live, we had some discussion around that, and I just think it's worth sort of. I've wondered this too, and to what extent can we rely on commodities, diversified commodities, or risk premium? And I actually think that if you're rebalancing between commodities, or maybe some sort of positive drift from rebalancing, just like the mathematics of rebalancing, stochastic portfolio theory. But even then, I also wonder whether or not the idea of a risk premium is even the right way to think about it. And really, it's you're buying insurance against certain conditional payoffs, right? So in an inflationary regime, on the condition of an inflationary regime, you're buying an insurance policy that will produce a massive payoff in that situation, right? If bonds, you're buying an asset or whatever, an insurance policy that'll have a massive payoff in a disinflationary regime. Stocks, you're buying an asset with a massive payoff in a growth regime, right? So if you don't sort of frame it as a risk premium, but more like I'm trying to hedge against all these different risks, and I'm buying payoffs with structurally different payoff profiles. That may be a better or another way of thinking about it.
100%. So I absolutely agree with what you're saying. From a factor perspective, we're not actually talking about risk premiums at all. We're just saying we want to say like. And the interesting thing about commodities, even the definition I use here, I'm going to argue they don't have much of a risk premium, but they are a positive paying hedge, and you'd be crazy not to take advantage of that. Now the other thing is, if you actually look at it and say everyone starts with risk parity, going stock bond risk parity because we're trying to cover growth risk. I hate bonds because they have inflation risk. A very interesting and equally compelling package is a commodity bond risk parity process. And it turns out you go, man, I can get the risk premium of bonds without the inflation risk. And of course the two of them together, those two packages into this three asset 2-factor package looks pretty good. It is a significantly better starting point. It's not perfect and it's not ideal. And just to run into it, this is the commodity process that I showed you. It does exactly what you needed from 1962 to 1978 in that inflation shock. It did really, really well. But from 1980 to today, the real return in commodities is very, very close to zero. And the question is why? Because weren't we all told that there was an equity-like risk premium in commodities? Weren't we all told that commodities pay money? And the answer is not really. Not really. There are risk premiums in commodities for sure. But they're not the same as stocks and bonds, where the risk premium is just buy some stocks and the risk premium is to the long side, and buy some bonds and the risk premium is to the wrong side. You'll find in commodities, sometimes the risk premium is to the long side, sometimes to the short side, and it's conditional and it's constantly changing. Now, this
I want to push back, right? Because I think, again, we've experienced this long disinflationary growth process. So if we had experienced a stagflationary process, an extended stagflationary process, then obviously commodities, or not obviously, but I would submit that commodities would represent, we would look back and say, wow, commodities have a really strong premium.
Possibly. It depends on the source of inflation. So, and you can define inflation lots of different ways, and people do. And then you even get debates on what is the definition of inflation? Is it increase in monetary supply? Is it increase in the price level? Is it the increase in the price of commodities? Is it there's at least Bridgewater has their 4 definitions of inflation risk. I would say if it's a commodity-driven inflation risk, yes, then commodities should cover it. It may not cover a monetary like inflation risk. It may not
certain commodities may help, right?
May not. So, but just to say, but that also speaks to less to a risk premium and more to the concept of a changing discount rate value to a certain extent. The question is, do they pay? If you just sat long this thing, would it pay you money over time? Is a different statement than could it be worth more or less through time, depending on different outcomes.
Okay.
And so,
yep, fair enough.
And so I would say if you look at commodities, there's a couple of things to pay attention to. Yeah, they do cover that inflation risk, or they did cover that one type of inflation risk that we certainly cared about in the 70s and late 60s into 1980. But they have pretty bad drawdown characteristics. I mean, it goes off the bottom of my chart here. And sometimes they lose money at the same time as equities, as everyone found out in 2008. So you go, is it a perfect diversifier? You go, no. But is it a really good playground for a quant? And the answer is absolutely, because first of all, commodities as a thing is a complete misnomer. It's like saying stocks and bonds. Commodities is at least 4 or 5 pretty independent sectors, almost asset classes that almost have nothing to do with each other. So there's more in here than just one thing. And you say and from that there's also really different characteristics about where the risk premium is at different points in time. And so this is
So Chris, before we move off, we have a good question that I think is related, right? So
okay.
Dan P asks, can you effectively hedge the inflation risk for your equity bond portfolio with inflation tail risk positions like calls or gold miners or out of the money puts on bonds, etc.? And I think that probably the drag there is probably significantly more than what you're seeing in your commodities. But can you elaborate at all? What are your thoughts there?
Sure. So just to run through that, you say, and gold is certainly part of your commodity. And so when we were thinking about commodity protection, when I've been thinking about commodity protection, I say like I said, I think there's 3 different types of inflation, right? So you can say that there's monetary inflation, there's price inflation, there's underlying commodity inflation, which flows through, call it
there's price index inflation.
Yeah, and so the if you kind of look at, well, you can attack those and defend against those in different ways, right? You can say maybe gold is a pretty good protector against monetary inflation. It might be at least, and the gold's interesting because gold is actually an inflation hedge and a deflation hedge. It's an inflation hedge and it's a shit show hedge, and that's why people kind of mess up, because when you actually measure the correlation of gold to inflation, it doesn't look great. Because you're actually realizing it's not a linear relationship at all. But if you measure the correlation of gold to inflation and then take away the downside, the deflation piece, the correlation comes up significantly. Mm-hmm. So gold is a decent inflation hedge, but not a perfect inflation hedge, not even close. If you want to do price, well, the easiest way to go at that is real return bonds or break evens if you want to really isolate the inflation piece. And if you want to talk about, well, if it comes from the commodity side, you should probably have some commodities. If it's and the main source of that tends to be the energies, but that flows through quite quickly into the ags, and you can see it. So you can basically see at least 3 different types of inflation. You go if you want to hedge inflation, you should probably have a basket of stuff that kind of attacks it from those 3 directions, right? Just to say you want to make sure you've got it kind of covered. Now, can you do gold miners? Well, there's a ton of business risk in that, and now you've introduced some equity risk into your inflation hedge. Can you buy calls and puts? And you go, yes. Absolutely, that is a classic form of insurance, but you're going to be paying a lot of money for it. The beauty of this approach is that these are all positive pay, negatively correlated on expectation, and so yes, and you can start to think about mitigating risks if you feel you have a particular source of risk you want to cover. But in general, we're going to try and build the portfolio. And when I think of risk parity, and this is how I've tried to explain it to people. It doesn't have to be a static portfolio. You don't have to only do this. In fact, you want to add lots to it. But I think I'm trying to build the portfolio. When I think of factor balanced, I'm trying to build the portfolio that I would want to have 10 years from now. Mm-hmm. Right? And we talked about this in the podcast, I think, but this is distinctly different than the portfolio I want to have over the next 10 years. It's the portfolio in 10 years, because I can tell you with certainty, no one has a view about whether stocks are going to outperform bonds in 10 years. Or whether commodities are going to outperform bonds in 10 years. No one has an active view 10 years from now. What is the portfolio that is as best as possible active view agnostic, right? That's your starting point. Now, you can put active bets all over it if you want to, but how do you define the most passive you can get away with getting without getting ridiculous? And go, this is a definition of, I think, of a pretty good definition of passive. It's like, I have no active views. This is the thing that's the do no harm
portfolio, right?
This is first and foremost, these guys protect each other. That's a great starting point.
Yep.
So now, as we said though, commodities. Here's the thing. They did really great till 1980, and then from 1980 to today, 0 real returns, right? And so can we do better? In fact, if you had a wish list of the perfect asset to hedge your stocks and bonds, you say, I want to have inflation hedging protection. I want it to ideally not have these terrible drawdowns, and I maybe not draw down at the same time as equities. And so you have this wish list of like, what would be the perfect, like balancing asset for stocks and bonds. And you go, I mean, probably sounds ridiculous. And you say, can we build that? Now I'm going to make a giant leap here and say, yep, we can. I think we can build it. And this is a very dumbed down, simplistic, sort of like simplified version of the types of things you can do. But just to say, we're going to call this an enhanced commodity process. I'm not going to talk about how it might be done, but I'm going to say, let's just say there's ways that you might want to do this. It's got some nice characteristics. And let's just pretend, just go with me for a second and say, imagine we could build something kind of like this. If you build a balanced portfolio of equal risk portfolio of stocks and bonds and this enhanced commodity process, and that's what you got on the right, and compare it to just your equity-centric portfolio, which you have on the left, you can see it's night and day. Mm-hmm. Now, it's, you say for the same monthly volatility, it makes about twice as much money. Or the other way you can say that is if you want to, you can run it at half the risk to make the same amount of return. But the real key feature is that it's got like less than 1/3 of that pain that the equity-centric portfolio has. And so I think it's fair to say this is a clearly better starting point than an equity-centric portfolio. And so now I'm just going to say, it looks great. Why don't we just put all our money in this and just go golfing for the rest of our lives? And the answer is because I've cheated like so badly in this in a bunch of different ways. And these are really, really important cheats because everyone commits like some part of these cheat. And I got to tell you, the reason you can't just do this and go, and the reason it's not going to be that easy, first of all, I just showed you US stocks and US bonds over the last 100 years. The US is the top performing stock and bond market in the world over the last 100 years. And I guess it kind of goes without saying, if I would say, look, of the 16 major indices, that have been around from 1900 to today, the US is by far the best. In fact, if you look at the next, I think the US has got that 4.5% real. I think the next best is like 2.5% real. So you say, what do equities owe you? What should you expect out of equities over the next 10, 50, 100 years? Unless you can tell me that of the 16 largest countries today, you know what the winner is going to be, and you put all your money in that, it doesn't owe you what the winner paid you over the last 100. It's probably more like what the median paid. That's like 250 basis points real. It's not as good as it looks. The other problem with that is I said of the 16 countries that survived, you go, but if you look at the biggest countries in 1900, a bunch of them went to zero. If you put your money in Russia or Egypt or Argentina, like countries that surprisingly were, very large, Germany, like zeros across the board.
Russia and China both went to zero.
Yeah,
and they were large economies
Austria.
back when they went there.
So just to say, if you follow the winner the whole way through, and if you do the median with adjusting for survivor bias, it's more like 150 basis points, and that's really generous. So we've got a real sense that equities owe us a lot more than I think they will ultimately pay, but I'm pretty sure that risk of them is an accurate representation of the risk. And that's the long term. That's not talking about today's starting point. So this is a difficult time for
we haven't even got there yet. Exactly.
Yeah. Okay. So the next thing is obviously I showed you a commodity model. I said, if I could have done this in 1965, look how great it was. And I said, just trust me, I can do this. Of course, I would not have known to do that in 1965. So there's a whole bunch of, we started doing similar things back in 2003, 2002. And they've continued to work, but you have to have a really strong argument as to why this is a persistent risk premium as opposed to just hey, if I know to do this thing, here's and you've got to hold people's feet to the fire to defend that. Fourth thing is it requires leverage, which a bunch of people can't do, and a bunch of people just refuse to do. And at the end of the day, they would rather sit on that incredibly risky equity portfolio than build a more diversified process that requires some leverage because they somehow feel that is risky while this isn't. And so because I think once again they're caught in some of these survivor bias, US-centric essentialism research problems. And then the last one, capacity. Not everyone can do this. If you're a $1 trillion pension plan, it's impossible to get enough inflation protection to cover your stock bond risk. And in fact, you probably don't have enough bonds either, and so you're probably just riding the equity process. And now your challenge as a CIO is to optimize that portfolio given the constraints you have, because there's a whole ton of constraints into that optimization. If you're too small, it becomes a bit hard to do, but there's an absolute sweet spot where you can actually probably, literally for the first time say, I think I have a competitive advantage over the big guys because I think I can still do this because I think there's the capacity and it requires a certain amount of sophistication, but it's doable.
Is
Right.
is the capacity on the inflation hedge probably the reason why Bridgewater worked with the U.S. government to launch the Treasury inflation protected securities?
It could be. I'm for sure they would have been looking for their inflation protection. Absolutely. I assume it's capacity. I mean, like, so the fact is, there's just not enough commodity futures out there for everyone to, like, for even a very small percentage of people to
You see limits as to what any one entity can own on that space.
Well,
the limits are there because there's only and so the banks will give you swaps around it, but it's somewhere sooner or later, there's a limited amount that you can do because there's not that many people want to get on the other side of that trade.
Even the swaps end up back in the futures market. I mean,
of course they have to, unless somehow you found an offset, and then you kind of go, so you have to come at it in different ways. And like I said, real return bonds is a pretty good one. Now the problem with real return bonds, or the challenge with them, is the break-even part, the inflation hedge part of it has got a negative expected return. So it's not a positive pay, it's a slight negative pay. That's not bad. Probably still worth doing some of. And then you say, well, gold, is it a positive? Probably a positive expected return, at least real neutral, but probably real plus something. And it's got that nice deflation hedge piece to it. So you probably want some gold in your process. And so you have to be a little bit creative about coming at it from, like, especially the inflation hedge side, because of the capacity limitations.
We've got one other question here too, and I think it's relevant. And it's just how does this work in those pinch points where the correlation of assets and the drift from historical positions? Basically, you're going to get some sort of liquidity contraction like we had in March, where there just isn't an asset. Even your long dated treasuries or your shorter dated treasuries had some liquidity pinch points.
Sure. So how does it work? First, I like I said, I did this last year and I couldn't show you these exact numbers. Is it bulletproof? Does it never lose? No. If you look at it on the bottom right, it's got volatility. Mm-hmm. It's what it doesn't have is clustered. In fact, it's a much more normal process. At 10% vol, you'll see some 20s, you'll see some 10s, you'll see some 15s, you'll see a 25. It's a much more normal process. You should run away scared from any process that says it's 10% vol. It doesn't have peak to trough pulls of 15 to 20% every 3 to 4 years, because it means it's not random walking. And when something doesn't random walk, it's almost always because the volatility has been hidden in higher order risk, in higher moment risk. And you can do that. You can always take something and reduce its volatility and increase its skew or kurtosis.
Selling vol has been a predominant feature of doing exactly
selling
that.
Vol, a lot of credit, a lot of insurance-linked securities, are things that, it takes a full cycle to realize the risk. And so it'll look like a Sharpe ratio of 2 until there's a -4 in there and it balances out at 0.5. But that looks more like equities, to be honest, right? You want a normal random walk process whenever you can. And you need to see those peak to trough pulls. You need to see losses. How does it do in March 2013? I'm not exactly sure, but what this one isn't, is a short-term vol targeting dynamic vol process. This is a long-term. I mean, I did this monthly. I'm just trying to roughly get the positions right. I'm not trying to deal with vol clusters in a way that you would probably do in the short term. It's an interesting question. How did it? We can always check. My guess is okay, but the fact is, you can't judge a process by 1 or 2 weeks. And I would also say, man, equities did not do well in that period either. So it's better than equities is probably a fair statement.
Actually, it's interesting. We've constantly commented on internally how the scrutiny of quant or systematic based strategies is so much higher than it is for more traditional strategies, right? If you've got a traditional manager who comes in to pitch his discretionary value quality strategy, he tells a nice little narrative. He describes the pitch for 4 or 5 stocks that he really likes right here and why they're the largest positions in the portfolio. And the CIO feels really good, and this guy knows what he's doing, and it maps to whatever he learned in his MBA. But when you go through a quant process, that everybody really begins to drill down to the details. It's like, yeah, but what are the tails? And yeah, but how did they do here? And yeah, but what do we expect here? And what are the go forward expectations? And what are the capacity constraints? And what's your trading costs? And it's amazing how when you empower people with more data, then what it does is it prompts more questions.
And you know what it is as well that really busts me up is the view that risk parity, that everybody's waiting for this risk parity to blow up. And when it has an inevitable 15%, 20% drawdown, see, I told you they were going to blow up. I told you it was going to blow up, right? There was nowhere to hide. Risk parity isn't real. What happens when everything correlates? And there were like 3 days that it correlated in March, and everything went down together. And when you're levered, that hurts. But it was a perfectly reasonable drawdown for a 10% volatility, a well-constructed 10 vol risk parity product cruised through this year. And yet it's in the headlines, it's risk parity blows up, right? Ask anybody, how do you think risk parity did that doesn't really know? They all think it blew up. It's astounding, the standards that we are expected to meet.
Sure. I think you're absolutely right. Let me just first of all, everyone starts off, 99% of investors start off and end up thinking to themselves, I'm a Warren Buffett actor. I invest like Warren Buffett. I want to buy low and sell high. I want to buy good things cheap. And because it's so intuitive, it doesn't mean it's easy to do. And it doesn't even mean that's that's the reason you're making your money. Yeah, exactly. But it's very intuitive. So I think the problem a lot of quants have is they don't properly explain the intuition, or they can't explain the intuition, and it becomes much, much harder as a selling feature. I think that's the first thing. I think the second thing is this is so anathema to how people think of what their role as an investor is. My role as an investor, and we always talk about this, the Sharpe ratio is return over risk. And they'll say, my role as an investor is to try and time things. I want to pick the winners. I'm trying to improve the return. And what we're saying is, hold on a second. You can do a much, much, much better job by improving the risk and keeping the returns constant, and then using a bit of leverage. And so it turns out it's much easier to come at it from the risk side, but people go, but that's not what investing is. Portfolio construction, I always think of portfolio construction as putting the pieces together as risk. And a lot of people are portfolio construction is about returns. And it's well, TAA is about returns, maybe. But at the end of the day, I really think this is why I really think the portfolio construction is I want my starting point that I can do my active stuff around, but what is my starting point? And the fact is risk is more stable. Correlations, in fact, are more stable. And they're easier to predict as a result. And they are something that you can put pressure on about the future. If you want to make predictions about the future, risk and correlations, risk in particular, correlations are hard, but risk in particular deserve weight. Yep. Because a 2-year bond tends to have less risk than a 10-year bond, and that's a pretty straightforward statement. Eurodollar futures tend to have less risk than gold. That is something you can pretty much go to the bank, and it won't always be the case, but it's enough to add value in the future. It's very, very hard to predict returns. Most people destroy value trying to predict returns, and I would say at the end of the day, start thinking about risk from the risk factor portfolio construction side. And then start to think, well, how can I add some alpha? How can I then start to juice the returns up? And it does.
Okay, so let's go there.
All right,
let's go there, because I think we all kind of agree on the risk parity as the neutral starting point, and I think all agree. We call this the impossible market, or navigating the impossible market. You say, okay, not impossible, but it's highly challenging. So let's go to that challenge, right? So we've got a well-diversified portfolio. We've taken a good crack at managing the risk of all these major economic environments, but this risk parity portfolio, given capital market assumptions, probably is not going to do it, right? It's not going to hit the required return target. It's not going to give you 5% real over the next 10 years in the way that it gave you more than 5% real over the last 20 years at the same level of all. So, right. You mentioned earlier, right? We can raise leverage a little bit, right? That helps a little bit, but there's when the expected return is 1 or 2% on your risk parity portfolio, there's a max sort of Kelly leverage that you're going to want to hit before your expected compound return begins to decay. And so you've got to add other edges to the pile in order to be able to pile on to get your 5% required return target. How do you think about that?
So there's 2 bits to that. And I think, and so the first one is, beta's returns are probably going to be lower today than they were historically. And you just said that as a statement. I think they're only 1 or 2%, but you've got to defend that statement, I think, a little bit. And you're going to say, why are they lower today? And the answer is they're lower because the price of everything is high. And for a given set of cash flows, if you're willing to pay twice as much for those cash flows now as you were 5 years ago, your expected returns come down as a result. And so when prices are high, for a given set of cash flows, you can think of that discount rate as the IRR, but the lower the discount rate, the lower your expected return. It sounds really obvious, but the problem is right now the discount rate across the board for everything is as low as it's ever been. You cannot escape the fact that expected returns are also as low as they've ever been. And
so let's break it down, right? Let's actually put some numbers on it. So what's the 10-year yields? What, in the 60 basis point range? And the equity risk premium is in the, and like short-term rates are in the I don't know, 0 range, right? And the equity risk premium, if you look at the median is in the 150 basis point range. Let's be generous and call it 200 basis points. So, and commodities, notwithstanding some sort of overlay, let's call it 0, right? Yeah. So the expected return real
is low
on 60-40 is obscenely low, on risk parity is obscenely low. Risk parity is going to give you the same return for probably a lot less volatility. I think you could argue that there may be some kind of rebalancing risk premium in risk parity that you don't get from 60-40. But notwithstanding all that, you're in the sort of 2 to 3% range max real, and it's probably substantially below that.
So the one thing is, you got it. So a couple points there, and you're right. Everything's low, and we can talk about why they're low because I think it's super important to understand. But just because yields are low in bonds doesn't mean the risk premium in bonds is low. And I think we talked about the bond risk premiums and yields, but like that's actually not the right way to think about it. Like the yields are on a bond, but you have to understand when we're talking about bonds, and if you want to compare, like a bond is not an asset class. A bond is a thing that you put your money in a 10-year bond, and 1 year from now it's a 9-year bond, and 5 years from now it's a 5-year bond, and the statistical characteristics of that thing are constantly changing until it turns into nothing. If you want to compare perpetuity, which is equities, to a perpetuity of fixed income, you have to start thinking about a rolled bond process. And if you really want to get it right, you probably have to talk about a funded rolled bond process.
Yep.
So if you want to compare a perpetuity of equities to a perpetuity of bonds, you got to look at levered rolled bonds. That is a completely different asset class than a bond.
The futures contract.
For futures contracts or swaps, or when you think about a funded levered process. And so think about what does a futures in bond look like? Well, futures in bond is arguably now a perpetuity. And so you want to compare apples to apples, you should probably think, well, what are the characteristics of the futures in bond and the futures in equities? And you go, the big characteristic of levered bonds, there's 2 of them, is that when the yields come down, the short rate tends to come down even further. And the top performing asset class almost on the planet over the last 30 years has been JGBs, Japanese bonds. When their yields fell below 100 basis points, they got better. Why? Because the short rate was 0 to negative, and the carry was still very good. If you can have 4% yield and 3% short rates, and you're only making 100 basis points in carry, you can still be making 100 basis points in carry at 100 yield. And so it doesn't mean that they will be always. It doesn't mean they're not enormously risky. Like there's lots of caveats to all this always, but there's a massive mistake that the other thing I think the real knock on bonds is that people tend to think of them in terms of their yield. No one knows what the price of a 10-year, because you can't talk about the price of 10 years. It doesn't make any sense, but you can talk about the yield. Mm-hmm. The yield is like saying the PE. And people go, oh, the yield's only 100 basis points, so bonds are worse. So bonds are quoted like kind of differently than equity. Equities like rise in value and people go, oh, they're better. Because they don't look at what's my forward-looking return. Bonds rise in value. People go, oh, the forward-looking return is lower because the yield's lower. And so there's a real, I think, mistake in that. The other thing about levered bonds is that they're a shockingly good global diversifier. So if you think about why do we do every global bond play on the planet is trying to diversify internationally, right? Everyone's trying to get into Asia and trying to get into EM and trying to get into LATAM and go, why? Because we need some diversification in our equities. The diversification on the equity side is okay. There's a little bit. Maybe you're, it's a 70-80% correlated, and maybe you get a 5 or 10% increase in your Sharpe ratio in your equities, maybe. Global bonds are incredibly good diversifiers because of that short rate, which is driven by the local central banks, and those tend to be relatively uncorrelated with each other. And so you've got this feature where the diversification benefit across global bonds is actually significantly better than it is across global equities. And central banks tend to drop the short rate when equities are doing badly. So global levered bonds are a better diversifier against equities. So you got to make sure you're defining bonds properly.
Chris, how does currency work? And continue your thought, but come back to how currency works into that as well, if you don't mind.
I mean, so typically when you're using futures, you can just sort of think you're thinking there's a local, and so you don't really have to worry about that. But I would say very much as a Canadian investor, you should be super aware of your currency exposures. And there's 2 lines of thought on FX hedging. One is FX has 0 expected return, and there's a cost to hedging. So why would I bother, right? And so you say I might as well have a completely unhedged portfolio. I might have a deliberately unhedged portfolio. I might have a policy where I literally reverse hedges if they were to show up because I want to be unhedged. And so you look at that and you say, well, what have I done? You say, well, imagine a pension plan in Canada that goes out and buys private assets in Brazil or Chile or in anywhere, and you end up with a whole bunch of short Canada long somewhere else from an FX perspective. And if you don't hedge it, you can end up with a very, very big short Canada, long exposure. And so from a Sharpe ratio investor who only cares about return, you go, why should I bother hedging? From a Sharpe ratio investor who cares about risk, you go, oh my God, I got this giant source of volatility with zero expected return.
Yeah, the tail's wagging the dog.
I've got this thing that it's just noise with zero. That is Sharpe ratio destructive. That is the worst use of an active risk budget you can imagine. I'm given a certain amount of risk to spend. I want to get the most amount of return for the risk I'm given. That's what I am as an investor. Why would I put it in something with zero expected return? For sure, you should hedge your currencies, but you have to be really careful. And this is like the CIO's challenge part 2 is you go, even if I knew how to build the maximum Sharpe ratio portfolio, I knew exactly what to do. I'm in a world of constrained resources, and my major constrained resource is my balance sheet. It's my leverage. And you go and you look at it and say, where am I spending my cash? And if you go and you hedge away your FX exposure, you have to set money aside to defend that, because there's a world where the stocks are falling and the FX is moving against you, and you got to come up with money. And if you don't, you can get really caught in a liquidity squeeze. And a couple pension plans, doing, I think, the right thing, hedging currency, but probably over hedging and not properly defending their cash on it, got themselves in a bit of trouble in 2008. So, do you currency hedge? Absolutely, but you have to think of that money as it's doing something. It's money I'm spending to improve my Sharpe ratio, like hiring an active team. And in fact, I think when we looked at it, we figured that if we currency hedged ourselves completely at teachers, the increase in Sharpe ratio was equivalent to the entire active management of teachers. So it's just to say, wow. That's a statement, because you've taken away the source of risk, and if you can replace that risk with better return.
I like that. So what about currencies as an actual asset class themselves? Did they play into this structure?
Clearly, when we said that commodities don't necessarily have a long side risk premium, obviously FX by definition does not have a long side risk premium, because there's not even a long side. Like, what are you talking about? Is it long Canada or long US? But are there risk premiums within commodities, just like there are risk premium within FX, just like there are risk premiums within commodities? Absolutely. Because all you need for a risk premium is a willing payer who's willing to pay money to someone else because it improves their position. They're paying that money because they're getting something beneficial out of it. You got a payer, you got a payee. That's exactly what the equity risk premium is. It's what the fixed income risk premium is, and those exist all over the place. And for sure, FX is still a great place to invest. But I would say you should not ever. Well, you should be very careful about the extra risk you take on. That wasn't. It's not. It kind of came as the baggage associated with another investment, but it's got a cost. And to think that the cost is only an expected return side is not to realize that the risk is a cost. And people go, well, risk isn't really a cost. Well, it absolutely is. You could have taken that risk budget and put it into equities, or put it into bonds, or put it into this diversified portfolio. Absolutely, risk is a cost, because you are risk constrained. Someone somewhere said you're only allowed to take X amount of risk, and your job is to make the most return you can for that risk. Now, do you have to hedge all your FX? No, because when you have this giant source of risk, and it's literally an overarching source of risk, you don't have to drive to zero for it to disappear into your portfolio. You just have to take it from a loud roar down to a dull roar. But once it's a dull roar, like the math of diversification starts to take over, and it starts to become a smaller and smaller contributor to your total portfolio. So there's a tipping point where you want to get it below that level, and then just be careful. If you're going to FX hedge, make sure that you've set that money aside. Now, there's one final debate in all of this, which is, but what if you really, really believe the correlation between Canadian dollars and equities is negative? And then you say, if I'm long US and short CAD, is that not a great trade in 2008? Is like, do I not think the Canadian dollar is going to get smoked if and every time the stock market falls? The answer is, it might. But you've got to be very, very careful making investment bets around correlation. Correlation is super noisy, super unstable, very hard to predict, not very dependable statistic.
And it didn't in 2020. It took a long time for it to start working.
Yeah, and it won't necessarily in an inflation crisis. It won't, so I would say that there is the reason why every big U.S. hedge fund on the planet doesn't hedge their equity risk with short CAD is because that would be insane. Like it would be a crazy additional source of risk. But I think the same,
it's so great. It's so great that you drive across the border, literally just fly your plane 30 miles across, land in Niagara Falls, Fort Erie, and have the same discussion about how you should be currency hedging. And it's a totally different ball game. Like, it's just not even same fishbowl. Anyway.
Fair enough. But it should be. It should be at least part of your discussion.
That's the point, right? It should be just like you said. You would no other asset manager on the planet would do that except for a Canadian asset manager would think about that.
Okay, so let's not hijack the conversation.
I'm sorry.
Is the
I digress.
The one that probably can slightly argue for a slight leaving a bit behind because there probably is a slight negative correlation there. But I just like be careful. Building a portfolio around an in-sample look back that says, hey, guess what? These things were negatively correlated over this period because, that is a super, super dangerous thing to do. You should probably be careful about ever building a portfolio around assumed negative correlations.
Right.
So it's
the most appropriate thing is to think about it as a different source of risk that you have to manage, and doing 100% of it is probably not a good idea.
I mean, like in our portfolios, we want like what we are investing is risk, and we're trying to make as much return as possible for the risk we're investing in an asset class that or an exposure that has zero expected return and lots of risk is very, very costly. It's quite literally like, anyway, and since it's very cheap to hedge, typically, I think that's an easy thing to do. It doesn't mean you completely hedge it, doesn't mean you hedge everything, but just be aware that there are tricks in there. But it does get to the CIO's challenge of going, where do I spend my bullets? Because if you
where do we spend the bullets?
Well, one thing, at the portfolio construction level, let's just start for a second ago. If I want to build this diversified portfolio,
all this currency shit.
Well, how many bullets do I have?
Fascinating.
Not that many. So the question is, like first of all, let's see, what's your, not right now, maybe, but on average in the long term, the biggest source of risk outside of equity risk for most pension plans is actually their liability stream. You say, like, we have this giant short bond position with a discount rate, and we say, if the discount rates come down, that's a real source of risk because your contribution rates go up. You may have to change your benefits. You can certainly fail just as easily from a discount rate move as you can from an equity fall. And so you should certainly be aware of that as a giant source of risk. So the first thing where you may want to spend that bullet, you go, oh man, I got the source of risk that's got zero expected return. Maybe I should hedge it. And you go, that's it. That's LDI. So liability-driven investing is the sort of the modern approach. You're going, we want to dampen that a bit. If you want to fully immunize your liabilities, you're going to need leverage, unless you're fully funded. And then you can use the rest to try and generate a little bit of excess of money. But assuming you're not fully funded, in other words, you're not quite literally using your risk-free rate as your actual discount rate, and you have it, which no one is. You're not fully funded, so you can't fully immunize without leverage. And so that's your first thing. I've only got so much balance sheet. I can only do so much leverage, and I can only do so much LDI. And you go, where else? What else is demanding on my balance sheet? Well, your capital markets team, your FX hedging, as we said, all your derivatives programs, and you go, and competing for that cash are your privates. Because you take that money out and you do FX hedging, but you don't set that money aside and you go spend it on something illiquid, you can't have both of those. And so this is the constrained resource that makes life really difficult. Because even if we all agree, which we probably should, that we're trying to get towards this maximum Sharpe ratio portfolio, there's only so close you can get to it given all your constraints. And that is the part of the CIO's challenge. So you go like, okay, I don't think beta is going to pay that well. It's not going to pay as well as it did in the last 15 years. It's impossible for it to pay as well as in the last 15 years because the entire driver of the return wasn't cash flow surprise to the upside. Very little cash flow surprising to the upside. Your real estate didn't go, oh my God, I made way more real estate than I expected because my cash flow is surprised. Your infrastructure didn't surprise on the cash flow side. It's just that someone was willing to pay more for the same cash flows 5 years later. That is a discount rate falling. You got paid on your privates from the bond side of them, from the discount rate side. And so you look at it and go, man, we don't like bonds here. And people don't like bonds here for a variety of reasons, but you can't really love a lot of the privates as well for the same reason, unless because the price is very, very high relative to the cash flows you're getting right now, historically high. And so that's a challenge as well. And so this is the classic, what got you here isn't necessarily going to get you there because it's not going to be as easy as and I hate this term like greater fool theory, but it's not going to be as easy as just finding someone willing to pay more than you paid 5 years from now and going, who's better than me? Because at the end of the day, that's not going to continue forever. And the falling discount rate, which does raise prices, because literally the present value of future cash flows goes up if you take the discount rate down. And so the central banks came in and went, discount rates are all down, prices are up. The problem with that is your forward-looking return. All you've done is taken your future returns and paid them to yourself today. Mm-hmm. So you literally, your prices are higher. We feel that richer now, but going forward, our expected return is proportionally lower. We are no better off.
What about the risk? What about the risk budget privates on the balance sheet? Right. So how do our institutions pricing risk on privates? Because I think that's a major problem there.
That's a very tricky thing to do. So you say, like, how do institutions price risk? And so, like, obviously it's in the news right now with AIMCO, and like, to a certain extent I'm unsympathetic, and to a certain extent I'm very sympathetic, because their risk system almost certainly did not look back 35 years, and so they would have shown zero chance of this happening according to their risk system. I don't think anyone's institutional risk system really looked back that far. Now, that doesn't mean that when the dealer came to you, because, like, a friend of mine, in the business said, like, the dealers would come to him every 6 months with this trade. There's this capped uncapped variance swap, and they said, it's got a Sharpe ratio of 15. And it did have a Sharpe ratio of 15. And kudos to him, because sometimes it's the trades you don't do, not the trades you do. But he went, yeah, it's got a Sharpe ratio of 15 over the last 30 years, actually. But it's got a Sharpe ratio of -2 over the last 31 years. And that's a crazy trade. Now, the thing is, like, so kudos for him not doing it, because it's super, super tempting to put the trade on that only once every 30 years blows you up. Because probably not going to happen in your lifetime. And you can look like a genius in between. So that's a problem. It's a risk system problem. It doesn't mean that was a terrible trade to do if you size it right. Like, it may still be a positive expected return, but clearly it has to be sized right. But it doesn't mean, like, we have got risks. It doesn't mean we have the private risk right either on average, because I don't think anyone's got the 35-year private model either. And if you've only got like a 10 or 15-year look back on privates, they also look very, very low risk. And so you see a lot of private models, like, okay, so we know for sure they're smoothed because they're basically the values are set by accountants, and they're lagged. If you could just take the S&P 500 and just lag it 6 months, that would look like a brand new asset class at the annual level. Like, quite literally, it would be uncorrelated. It would be zero correlation. You say, like, technically, that's amazing. It's like, I would call that 2 assets instead of 1. My Sharpe ratio goes up by like 40% if all I did was just lag something by 6 months. But that's at the 1-year level. At the 3-year level, of course, the fact that they're 6 months lag starts to show up. At the 5-year level, they're 100% correlated again. It's artificial. So lagging looks good at the 1-year level. It looks good at the 2-year level. It's a bit artificial over that. The smoothing is artificial as well, because while the volatility is not shown, of course, there's trending with zero correlation, and that's almost the definition of it. So it still has the same, or should have the same, peak to troughs. Now, it may also have a grind up, slam down dynamic where it only shows its risk every 10 years. And you go, this becomes a really hard thing to risk, and it becomes a trap, right? Because what you see is really good diversifier, really low risk, never blown up. And so you can imagine why someone might think, well, maybe infrastructure is like as risky as a Canadian bond. You go, can't be, because it has all the discount rate risk, but it also, at the end of the day, the reason these assets, the reason real estate or infrastructure or the privates are paying more than the risk-free rate is because they have equity risk. They have business risk in them. And so this is what you will see, I think, in a COVID strike, is you'll start to see the business risk in a bunch of these assets, because there are business risks. That's what you're getting paid for. And so it's a bond, and it's paid like a bond. And it's somewhere along the way, we never saw the cash flow hit. And so we went, oh, there's no risk in the cash flows. Well, of course there's risk in the cash flows. And there's the danger of leveraging something up too much. If you take an asset class, and if you take an asset levered up 8 or 9 times, it only takes a small decrease in cash flows before you get yourself into some trouble. So I'm sympathetic to AIMCO, because I don't think their risk system would have caught it. I don't think many pension plans' risk systems would have caught it. I think pension plan risk systems have also misdiagnosed risk in a lot of assets, maybe possibly underrepresented risk in some asset classes. But the problem with and so this is sort of I don't know if this is a good analogy or not, but Nassim Taleb has this definition of fragility, and it's and he's got a really good example I really like, because he goes like 50 years or 100 years ago, and I'm going to totally butcher the story, but just go with the gist of it. But 50 or 100 years ago, the power grids were all localized, and so you had your local power generator, and there were brownouts all the time, because these things would constantly go down, and every single time one had a problem, you'd have a local brownout, and it kind of sucked. And so fast forward 50 years, and you've got this incredible process of overflows and dependencies, and you've got this extremely optimized process, but it's incredibly fragile now. And so what happens if one squirrel in a transistor, or whatever, out in the East Coast, it takes down the entire East Coast grid. And so you go from a large number of relatively unimportant brownouts to a catastrophic blackout. And I kind of think that's how I think about risk, because if you think about what the public markets show you, is they constantly show you their risk. There is no hiding the risk of a public market. There's no hiding from March in 2020. There's no hiding from 2008. The risk is there, and it's in your face, and so you see it and you know it. Well, the privates hide their risk. The risk is there, and it will show up, and it shows up over, unfortunately, 2008 didn't show up because it was so fast that by the time they had to start marking down 2009, it was already coming back. A 2000 and 2003 will show it. A 1965 to 1975 will show it. And so at the end of the day, I think we potentially have this fragile system because we haven't seen the risk and we think that it's not there, and because it's being hidden away to a certain extent, and we've taken short-term volatility, local brownouts, and we've turned it into bigger, probably more catastrophic type explosions, much less frequently. So that's the challenge with privates and risk.
So we've covered all these. So we covered the equities, the bonds, the private equity. We're now in 0 to 2% land territory going forward. You were about to say, how can we improve this as quants?
All right. Well, this is like I can't get into this too much, but I would say I want to say first of all, set up how we could have solved it 15 years ago. Right, and so this is a chart. Look, completely made this up. So, and I can walk through it bit by bit, but just to say, when you look at what the world looked like in 2006, and you said, like, how did most institutions invest? You said we had some stocks, we had some bonds, and that confidence. I created this chart, and I kind of went, confidence to me is not how high the Sharpe ratio is, but just that it's positive. I think that these things pay money over time. I don't know how much. Like I said, who knows what equities owe you for real over 100 years, but I think it's positive, and I think credit. A mixture of stocks and bonds with some vol selling and some illiquidity is probably positive too. And so pension plans played in that stock, bond, credit. That alpha, I think, is where a lot of pension plans played as well. That's stock picking alpha, like trying to add value above and beyond the portfolio. I tend to think of that as being a zero-sum game. So like, how confident am I it's going to be positive? Well, you think that you're skilled, you think that you're above average skilled, that you think that maybe you should be able to produce positive, but then so does everyone. Let's just call it zero for a second. Doesn't mean you can't add value there, but it's harder to think that it owes you money. And then I would say, there's all those liquid alts, right? And I think these were mostly overlooked by pension plans in 2006, 2005. I mean, like I said in the podcast, as you started trying to say, like, how can we build a diversified portfolio of alternative risk premiums, and what would that look like? Part of the pushback is always, look, if it was this good and this easy, why wouldn't everyone do it? And so most people didn't, but there was a ton of other tools in your toolkit that you could have added. And I would say the key to investing for sure is to avoid the crowds. If you can anticipate and get in front of the crowds, that could work for a while. But a crowded trade by definition, if more people have bought it than should, let's call that crowded, its price gets bid up and its expected returns come down as a result. So crowded. So
would you agree with, I've been playing with this framework for the last couple of years, which is basically that to the extent that a strategy or an asset class or a methodology becomes well within the Overton window, it is accepted by academia, it's accepted by institutional allocators. There's such a good story for why it should work. Literally, the expected return is inversely proportional to those dynamics, right? Like, to the extent that everybody accepts that this is something valid, that is sustainable, that is persistent, that has a attractive risk premium, the fact that enough people accept it to be true, it validates it. Or if not invalidates
maybe not totally,
diminishes the Sharpe ratio to the point where it's no longer serves the function that you want.
And the sort of the analogy I always sort of mention is like the alchemist dilemma, right? You're an alchemist, and you spend your entire life trying to figure out how to turn straw into gold, because if you do, man, will you ever be rich? Without realizing that if you figured out how to turn straw into gold, you wouldn't be rich. You would just make gold useless and worthless. Yeah. And so at the end of the day, you go like these things are only good if not everyone can do them. And it doesn't mean they shouldn't be still in your portfolio. I still think they're positive return and they should absolutely still be in your portfolio. They won't be as good as they were because they're crowded. But so is infrastructure, so is real estate, so is private equity. Everything's crowded. The returns going forward are going to be a lot harder than they were over the last 10 years. So that's the thing. And so I would just say that this was sort of the point of this chart, was to go fast forward to 2018. And of course, I totally made this up again. But I would say, like, those things that used to be considered hedge fund alpha and really sophisticated and really not what people thought about doing in-house or exposing themselves to in-house, more and more pension plans bit by bit started to include them in-house. And as a result, their returns came down. And so you got two issues. The returns get compressed as more people do it. The correlations come up as more people do it. The risk goes up as more people do it. And you go, net, it's a worse trade. And you also have this other massive problem in all of this when things get crowded. It's not just the pension plans, but it's the banks, it's the hedge funds, like a lot of people pursuing the same strategies. And you go, what is the natural, why would you think there's any correlation between the cash flows produced by commodity backwardation contango and FX carry. You go, there's no reason they should be correlated. They are 100% different things. But if the same multi-strat is doing both of them and is forced to delever at the same time, they will both lose money at the same time. The more people are doing the same thing, the more giant multi-strats trade all these strategies, the more they just become correlated by the flows in and out of them. And so not only the returns get driven down and the individual risks come up, but the correlations have this capacity to spike. And if you see a grand deleveraging or liquidity event, the diversification benefit you're used to seeing sort of disappears. And that is the major challenge in this space right now. And I think it goes back to, Adam, your question, like, why do people really, what's one of their fears about systematic? And they go, well, part of it is what happens if the future is different than the past? And there's always that risk there. And I think there's a natural sense to go, maybe the things that worked well won't necessarily, and there's a shift there. But it's also the problem, like the beauty of these things and the neat sort of part that where people can do them is because if you build a CTA and I build a CTA, our CTAs are going to be like 80 or 90% correlated. Maybe not. Maybe like basic trend probably might be, and it's up to you to try and improve it. But the fact is, a lot of people have a general sense of how these things work, and they're all kind of doing the same thing at the same time. So that you don't have that risk with a discretionary guy as much. They could be like group thinking. They all could be doing the same thing. But this has that extra risk of, man, they could all lose at the same time. All your strategies lose at the same time. And also, like, when people get too big, it becomes harder for them to make money. And when people get too successful, other people start to copy them. And that is more of a risk in systematic than in discretionary.
It feels like the risk avoiding behaviors of a systematic investor. We all share that in common. We identify the same risks and we try to avoid them in the same way. Versus a discretionary manager is more opportunity seeking, which generally or may not always involve the same bets. Yeah, and certainly it's a hook into individuals. People like to talk more about opportunity seeking than they do risk avoiding. But
welcome, Jason. I saw you here the whole time.
Sorry,
listening,
I've been sitting here drinking. I came late. Sorry to interrupt.
It's happy hour. You had stuff to do. It's fine.
Yeah, exactly.
So I think so. It doesn't mean that they can successfully do it, but it's an intuitive territory.
Totally.
And I would say, it just comes down to what the systematic guys have to be constantly doing and trying to do is that they're trying to get off to the right, out of the crowds, into the non-crowded space. And I think that is honestly, and the problem with this is that complexity and sophistication curve of the world is constantly moving to the right, as it should. And that's a great thing, but you have to stay off to the right of it. So you can't be doing what you're doing back in 2006 in 2018, or you can, but you don't expect the same returns. Now, I would still say, I don't expect the same returns from anything in 2018 that they would have given you in 2006. Infrastructure in 2006, small number of really big, sophisticated players pursuing a deal. And in 2018, 50 sophisticated big players pursuing the same deals. It's very hard to imagine that you can get the same deal now that you could have gotten then. I mean, it just, like, this is it. It gets harder and harder and harder. And so really the onus and the challenge for the alpha investor is how do we get away from the crowd? How do we avoid the crowd? How do we do stuff in front of the crowd? And that's ultimately, to a certain extent what I'm working on. And I think what everyone should be working on as well.
So we completely agree, but I just think it's this incredibly rich psychological challenge because you've got this situation where you need to be so far ahead of the curve in order to be able to capitalize on innovations and inefficiencies that the rest of the market hasn't recognized yet. But until it goes into the Overton window, until it has an explanation that people can get behind and understand, until a sufficient number of your peer group embrace the same thinking, then you don't get any assets in it, right? Like, so it's this incredible paradox, right? Like the innovation happens out here where it's uncomfortable, where your peer group don't understand it, they're not allocating to it. It's strange. It probably is sophisticated, but it's also it's complicated. It's complex. It's using new technology, new ways of thinking about it, right? It's still maybe machine learning is a bad example, but it's an example of this where the tool set's different. Most people aren't trained in it. And so it's out of the Overton window. People don't know how to evaluate it. And so it's uncomfortable, but that's where the alpha is. And no one's willing to go there. And maybe it's because no one's willing to go there.
Which is the
which girl is going to be perceived as the most beautiful girl. Like it is, this is the Keynesian beauty contest. 100%. You have an Overton window. You have to guess where that window is going to go, which is what's the prettiest girl in the room, not by you, but by everybody around you.
So I think what you're saying, right, is that you've got a group of, it's not enough to have a group of strategies or strategies that are effective. They also have to be strategies that you can describe using language that a sufficient number of investors can connect with and say, oh yeah, I get that. Or like, there's papers on that from credible sources that I respect. And, you know,
that's the challenge, right?
You've been at this for 6 months now, right? Like, and you're looking at other factors that have an explanation or that you've come up with that have explanations. But the moment that you explain, I think you said there's like 20 different factors that you've identified beyond what's well documented in academic. I always find it interesting. I'm curious to hear how it's been for you as you're pitching this when you can't actually describe it, because then your IP will go away.
Well, so first of all, a surprising number of investors ask you to just describe it. And so then you've got to be very, very careful, because if your entire thesis is I'm doing stuff other people aren't, it's pretty hard to go and let me tell everyone what I'm doing. So there's always that I mean, like, this is a terrible analogy. I'm going to get in trouble for this, but I'm not going to say it. Forget it. I'm pulling out. Okay. Anyway.
Come on.
Nobody's watching. Look, how many people are following? An hour and a half. Everybody's gone.
Anyway, I would say you have to be able to describe the intuition behind the thought process, and you have to be able to demonstrate that it's not black box, that it's not quant, that it's not data mined, but that there's something you're approaching, and you're approaching it in the way that you've always been approaching it. And this is like, it is without a doubt, it's very, very hard for most investors to be proper contrarian. And like I said, you want to buy when people are selling, you want to sell when they're buying, you want to avoid the overcrowded stuff, and you want to find the undercrowded stuff, and you want to get there early. Everyone thinks they're Warren Buffett. Everyone thinks they're that person, but no one actually.
No, but I would argue that in fact, most quants think they're AQR, right? Like, because AQR created a model, which is we're quant, but we're going to fully disclose everything that we're doing so that you can understand it. We're going to create an economic intuition. We're going to write white papers on it, and by you getting an intuition, understanding the narrative, and then showing us what is essentially backtest results and support. That is how we're going to get assets in the door, because that combination of things, of people getting comfort with the narrative and then seeing the backtest, is what allows big money to commit.
And
but without that,
it's fascinating because when you look at our pitch books, when we talk about risk parity, we have 45 slides because we can talk about every aspect of it, right? Then you get into kind of like the risk parity plus factors. We're looking at 35 slides. And then now we're doing, we've got the machine learning thing, and it's 5 slides because there's not much more we want or can say.
Disclose. Yeah. Exactly.
And so you have, a smaller set of individuals that are willing to go there.
I totally agree. Selling it is not easy. It's not people's natural predilection on how they think about investing, and a lot of investors hate it. Like, you're not just like, hey, you're not going up against like someone has no real view. A lot of people, this is not what investing is. Investing is understanding the name and doing the research, and so like, I think that that's a bit of a challenge. I think like AQR has obviously done an amazing job of selling it. So like, I think they've done a very good job of telling the story and of showing the back tests, and you have to be careful. I mean, like, anyone can show up with a back test, and so it's really like, I am very sympathetic to the investor, because it's really hard for an investor. Because most investors in the space haven't actually invested in the space, and so they can't tell a good story from a bad story, and that's the problem.
And
different is like 9 out of 10 different things will lose money. Like, different, it has to be different, but it has to be believable, and it has to have some hook in behind it where you've got to be dependable, I guess, is the piece of it, and ultimately a lot of that comes down to it's people typically want to see you up and running with a track record, and of course they should, and absolutely, that makes absolutely tons of sense. People, they want to hear you explain it in a way that makes sense to them, and you have to get to that too. And you're right, this is a significant challenge, because no one has to tell you, I buy low and sell high. I look for good value. Like, I buy shopping malls. It's like, it sounds obvious that it might take 100 pages to even start to describe all the risks that you might potentially expose yourself to when you buy an airport. Like those are not easy and simple things, but you don't have to explain why. You know, you don't, exactly. and so there's less defense and you know, for better or for worse, it's the space we're in. I think a lot of the time it's like, and the other part is obviously we have to keep moving always. And so I think like the other part of the why, and this is the part I focus on a little bit, you can't guarantee returns. Like, you know, if you've got these 20 different things and okay, each one of them backtests as well as a CTA, you go, hey, this would be great if they all did that. Don't know how they're going to do out of sample. Don't know, you know, you can just say like, you know, there's a little bit of, I've done this for a long time and there's a robustness behind the process and the thought process, but nothing is guaranteed on the return side. But what I can spend a bit more time focusing on is the correlation side, because the correlation and risk is where I think I actually can, bit by bit, produce something that I think I can defend. And so, you know, if I say like, I can't tell you I've got 20 things that all make money. In fact, I can pretty much guarantee that at any given point in time, 2 or 3 of them, if they were independent processes, would be losing money, because that's just the way it goes. But I can say that they will be relatively independent to each other and to other things. And you go, that's what, like, if I said like, what would I want as an investor? It's like, I've got this stuff here. I've got the stocks, I got the bonds, I got the liquid alts. I can get those relatively cheap now. I've got the global macro. I've got all this stuff. I'm looking for this other stuff, but I don't want it to be correlated to the stuff I already have, because that becomes a massive portfolio construction headache. What I need is different and uncorrelated. And that I think is, and that to me anyway, is the pitch I would have wanted to hear. I don't typically pitch to myself, but it's a, you know, and there's obviously different targets, different audiences, and different levels of sophistication. But I'm very sympathetic to the investor who hears the same story 9 times because everyone's story sounds the same. If salespeople are very good and you hear a good story, it will get repeated over time. And so that's
also, you know, one of the challenges I think is, like you said, they're thrown back tests all the time. They look fantastic. But there's also the added level of a lot of these people throwing back tests to the investors believe strongly that what they've done is real, right? That there's a lot of low sophistication in order to be able to go on. What was that website that people throw at us all the time? an ETF backtesting website.
ETF Replay.
ETF Replay, right? That anybody can go to this tool, backtest anything they want. Advisors, asset managers, ETF providers, they create an index out of these backtests, and they believe it. They believe it, and that belief that they have while they're pitching it, that passion gets to the other side. They believe it. They go live. They lose money. And so it's tough to differentiate a good backtest and a solid story from a bad backtest, because they're not bad people, those that put those backtests in front of them. They're just novice quants that haven't gotten there yet.
Yeah, I totally agree. And like model building and systematic model building is a skill set. And this is where, like, you think about like, well, how big does your team have to be? Because you can imagine a team of 70, like a lot of, or geez, 300 or 400, and you go, or you can have a team of 3 or 4. And I'm always prefer a smaller team, because I think the skill set is in the building of the models. I don't think you need to have I build models in commodities, or I build models in FX, or I'm a subject matter expert in this one little small area, because I think like the danger of that is you end up data mining that one little piece of material, where what you're really trying to find is common ideas that work across the board. If you have a model that you have to be very careful. You see this all the time, where you have a model that it works in FX and doesn't work in commodities. And if you're just an FX person, you'd be like, done. But you're someone else going, oh, it only works in half the things I tested. No. And so like I think there's a real value to saying my expertise is in model building, not in the asset class. And if you want to show something and you're trying to capture some sort of process, you have to be able to demonstrate that you can capture broadly across the board. There's a lot to the skill set of model building and risk control and portfolio construction and putting it together. And that's why people want to see a history, an out of sample process. You've gone to work somewhere and you've done it for a long time. Something that says I haven't just picked up a machine, and I haven't just started data mining. And so that's, but the problem is it's hard for an investor to tell the difference without those, without those sort of that backup. And so like it's hard and getting harder to get started.
Because the only people that can evaluate whether you have merit are the people that can already do it themselves, right? Like,
or the people that can start teasing out what you're doing and saying, "Oh, I got it, I'm good." Right? They're the other quants. It's like when walking into teachers. Could you imagine walking into teachers with your quant model, 20 people in the room? What are they going to do? Invest in you? Vultures.
I don't know what you're saying, but so yeah, no, I mean, I was like, I mean, obviously teachers, external manager group, the vast majority of them don't invest themselves, and they just invest in managers. We were a very unique team, and we would start every conversation with, just so you know, I run a prop shop internally, and like start with that. And I'm here to talk about risk, portfolio construction, thought process, you know, because I've got your returns. I've already correlated them against my returns. I see you're doing something different. I now want to think about how you think about model building. But I think it's an atypical approach, and I think it's a hard approach. And so, you know, like I said, it's hard for investors to invest, and they get burned.
So Chris, you were uniquely qualified to be able to do that because you built your own internal models, right? For those who don't run their internal prop desk, they don't know what to ask. They don't know what to look for. Like it's a catch-22. And I agree. I mean, we contact with this all the time. We're very sympathetic to the end investor. And it's very hard.
It's, you know, you won't stick your finger in that socket over and over again, but you seem to be more comfortable with like, okay, that discretionary guy was no good, but getting the next discretionary guy and get the next one. Or, you know, or you go like, you know, there's like certain, I'm not picking on credit necessarily, but a lot, you know, credit's got, as an asset class is great because it's a mixture of stocks, bonds, and vol selling. It's a lot of betas. Like there's not a lot of alpha in credit in itself. There is relative value credit you can do, but typically, like if you think of it as an asset class, just as it blows up, everyone loves it the most. It's like, well, like, okay, we just got smoked in this thing, but look how good the spreads are now. And so it's a, you know, it's one of those things where even the S&P 500, people go, oh, it just got killed, but I love it more now. There will be
people buying bank stocks in March, right? In Canada, yeah, for sure.
Yeah, and so I think on the systematic side, some of these models got too crowded. Some of them got too common. Too many people were doing them, and I think there might be a rebalancing where bit by bit some of the money comes out, and I think they will start to work again. They probably will never be as good as they were when not many people were doing it. But I think at the end of the day, there's room for new stuff too. There's always new stuff, and
How big is that new stuff? Like it seems like a lot of investors are using it as a shortcut capacity. They want to find these strategies that have low capacity because they believe that's where the magic must be, which can make sense because as the intelligence spreads and the weaponry is shared amongst all of the quants out there, we all have lots of weapons and lots of brains. So the only place to go may be the small capacity strategies.
So my answer to that is a little bit of yes, a little bit of no. You got to be careful. So the question is, what's small capacity? You can run anything at any size, like unless you literally like eat up the entire market. But like, what you're really saying when you're saying small capacity is your transaction cost at some point or your market impact overcomes your alpha process. And so there's two answers to that. And the first one is, well, where do you have market impact or high transaction costs? And a lot of that small capacity is either very illiquid or EM, or on the less, you know, like so you got some guys who are just trend following, you know, pretty illiquid and pretty small stuff. The challenge with that is that your cost to trade it is significantly higher, and so you've just got to make sure. So the pressure then moves away from a signal, or it moves in addition to a signal, to really top-notch execution. And like this, by the way, execution I can go on for hours, but just to give like quick execution is extraordinarily important for everyone. You know, and the discretionary guys they typically don't intuit it. And in fact, we had I got to take a 1-minute story here. But we had a hedge fund manager who had all these, I'd say like 1,000 different alpha managers, each making stock picks. And these stock picks were, you know, like 6 months to 1 year hold. Like, you know, really, you know, like they're not high turnover. They're not really like massively diversified portfolios. It's like 5 to 10 names, and you're just doing a very concentrated process. And they asked them, they said, well, you know, first of all, none of them really thought transaction costs mattered that much for them. And the answer is, well, why? And they said, what do you think you make per trade? And the answer was, between all 1,000, the lowest was 400 basis points, 4%, and the highest was, I think, 1,000 basis points, around 10%. The expectation is if you're making between 4 and 10% per trade on expectation, you're not buying Microsoft with the expectation of making 2 basis points. Then what does it matter if I trade for 15 basis points or 25 basis points in cash equity? It doesn't, because I'm making 10,000. You know, I'm making so much. And the answer is, when they went through this entire set, and by the way, for this number to even be positive, it means that you've got alpha at the very, very least. But across all of them, the answer was 51 basis points. And because there's this massive intuitive flaw in what they're doing, because they're going, how much do I expect to make if I get it right? without realizing their hit rate is like 51 or 52%. Of course, they can have the trades wrong. It doesn't mean that you ride it all the way down, but if you stop it out early, it means that you actually have more losers than winners. But like, long story short, if you have like a 52% hit rate and you make 400 on the upside, but you lose 400 on the downside, you're at 50, you're not even at 50 basis points in that story. And then is it 15 or 25? It's like, oh my God, it's a quarter or half of my alpha. And so does it matter? It absolutely matters. And it matters for long-term hold discretionary guys. And does it matter for systematic guys? It matters way more. And so, which is why, and we've talked about this in the past, you have to demonstrate strong signals and strong processes and independence and portfolio construction risk. And you also have to demonstrate, or you have to focus and pay attention on execution. And I think execution typically means, it doesn't mean, because you can spend $1 billion a year or more on execution. I'm not making that number up, because like, there's high frequency shops that will, you can spend enormous amounts. You don't have to. I think the key is to not be the worst, not be the fish that's constantly getting killed. Your job is to just kind of do okay. But it's a hard world, because you're up against the smartest, the best resource, the richest people on the planet when you're going into execution land. And that is a very significant and very important focus. And so I would just say the problem with, just to come full circle, the problem with those low capacity trades is what you're really saying is expensive or hard to trade trades. Or you're running it to a size where it becomes expensive or hard to trade, and you go, maybe, but you got to be super careful of your back test in that world. And you've got to be like really properly not going near the top end of those capacity, because if you start to push it, you can really start to get yourself into trouble. And then you got to hope that there aren't other people also going into the same time as you in a similar manner. And that's obviously the quant's real challenge is, well, let's say it's once again, it's a prisoner's dilemma. For me, like the right thing to do is to run this thing at $500 million of assets, because above that, it starts to degrade risk. And then some other gorilla comes in and runs it at 2 billion and kills it for both of you. And you're like, well, I guess I should have taken it while I could have, because at the end of the day, it doesn't do me any good to be the good corporate citizen when someone else is just going to come and eat it all. And of course, that leads to a very quick destruction of the commons. And so that's ultimately, it's very, very hard to know that it's being that thing that you found that other people may have also found isn't also being like overrun.
So, gents, you guys can say my wife just called me 3 times, so clearly I'm needed to have some further drinks with the neighbors. But I'll let you
more
guys.
interesting conversation. You're like one that I'll be
I made promises, man. I made promises. I said that we're going to be done at 5 on average, and I told her Schindler was on the call, so it's going to be probably another half an hour, and now I'm going into 40 minutes.
Done. Excellent.
But you guys can
I think it's great, because we spent all this time talking about all the ways that you're not going to hit 5%. So there's a whole other podcast on how you can actually hit 5%.
We said the way to do it is to go out to do things that nobody else is doing.
For sure. You're right. Go find the stuff that we can't tell you about, that we can't describe to you, but where you've got smooth operators that you can trust. I agree.
There you go.
Yeah.
Or buy gold. I mean, that's another.
That's right. A lot of gold.
20% gold and 0% allocation to the S&P.
You just gave Phil Brick 20 more minutes of conversation.
Yeah, let's go. I think we should zero out our S&P allocation. That should always be zero. Your optimization for the next 15 years should just zero out the S&P and the NASDAQ and put it towards gold. You'll be fine.
Bitcoin has a sharp ratio of
not advice.
This is not advice. We're kidding. We're just kidding.
Or the S&P goes straight up for the next 10 years. I mean, like look.
100% could happen. Yeah.
Don't know. So it's a tricky world. And this is why this is ultimately why portfolio construction is this and this and this, not ors. Like I love the ands, not the ors, because I think that gives you the best fighting chance because you don't know.
Of course.
Portfolio construction is about giving yourself as many ways to win. And giving yourself the least number of ways to lose. And I think that's at the end of the day, and that's what you got to be focusing on is what happens if a thing you don't expect to have happens. Do I have something in my portfolio that does okay in that world? And I think if you come full circle, that's ultimately what you're trying to do at the aggregate level. And then alpha's hard. But
amen.
There you go.
Stealing lunch money. That's a tough game.
Yeah.
All right. Anyway, good luck to the CIOs.
Yeah.
We'll have more guidance for them as we go along. We'll have you back again in about 6 months.
That's right.
All right.
Yeah.
Excellent.
Listen, that was wonderful as usual. Thanks a lot. And thanks for everyone for sticking with us for an hour and 40 minutes. It's been
like 2 people left.
All right, Chris.
All right. See you later.
Enjoy your weekend.
Good weekend.
See y'all.
You too.
Bye.